Welcome to Pipster. Have you ever looked at a price chart and it just looks like a bunch of random chaotic squiggles? Well, what if I told you there's a hidden map underneath all of that? Today we're going to learn how to read that map. We're diving into one of the most fundamental concepts in all of technical analysis: support and resistance. Here's how we're going to do it. First, we'll cover the absolute basics, what I like to call the floor and the ceiling. Then we'll look at how that terrain can shift with static versus dynamic levels. After that, we'll get into the fun stuff: how to actually trade bounces and breaks. And finally, we'll wrap up with some advanced tools to help you confirm the clues the market is giving you. Alright, let's start at square one. The easiest way to wrap your head around support and resistance is to just picture a room with a very clear floor and a ceiling. So support is your price floor. Imagine a price is falling and falling, and then it hits a point where a whole bunch of buyers jump in, all thinking, hey, this is a bargain. That sudden rush of buying interest creates a floor, stopping the price from dropping any further. It's basically a zone where demand simply overwhelms supply. And on the flip side, you've got resistance. That's your price ceiling. The price is climbing, things are looking great, and then it hits a level where sellers start thinking, you know what? It's time to cash out. That wave of selling pressure hits the market and stops the price from going any higher. It's the ceiling, and check this out. Here's what it looks like in the real world. You can literally see the price bouncing between these two levels. It's contained by that floor of buyers down at support and capped by that ceiling of sellers up at resistance. This creates a really predictable channel, or what traders call a range. But why does this even happen? It's not magic, and I love this quote from Investopedia because it gets right to the point. These levels work because of us. Because of human psychology. Traders remember where prices turned around before. So if a stock bounced hard at $50 last time, you can bet traders are watching that $50 level again, ready to pounce. It becomes a self-fulfilling prophecy. So how do you actually find these levels on a chart? Well, here are 3 super simple rules to get you started. 1, the price needs to hit a level and turn away at least twice. 1 touch is just a point, but 2 touches make a line. 2, the more times a level is tested and holds, the stronger it is. Think of it like a wall that gets thicker with every hit. And 3, what happened last month is way more important than what happened 10 years ago. Recent history matters most. Okay, so we've got our floors and our ceilings, but here's a little twist for you. The terrain of our map isn't always flat. Sometimes it moves, and that brings us to a really important distinction between static and dynamic levels. This chart breaks it down perfectly. Static levels are those fixed horizontal lines we've been looking at. They're awesome for markets that are just chopping back and forth. Dynamic levels, on the other hand, are things like moving averages, or VWAP. They actually move with the price, which makes them way better for markets that are clearly trending up or down. And get this, see that data point? Dynamic levels tend to have fewer false breakouts because they adapt to the market in real time. And here's a fantastic visual to lock this in. See on the left, those are your classic static levels, like stair steps. But on the right, you see that curving line? That's a moving average acting as a dynamic support, literally flowing upwards along with the price. It's about using the right tool for the right job. Alright, so now that we know how to draw our map, how do traders actually use it to find their way? Well, it pretty much boils down to 2 core strategies: trading the bounce or trading the break. First up is range trading. This is when you're betting that the floor and the ceiling are going to hold strong. So you might buy when the price gets down near support and then sell when it gets back up near resistance. The other strategy is breakout trading. This is the complete opposite. You're betting that the level's about to shatter and you're trying to catch the powerful new trend that you think is about to start. Now, this is where things get really fascinating. It's a phenomenon called role reversal. When a support level, a price floor, is decisively broken, it very often becomes a new resistance level. It turns into a ceiling. Think about it. Anyone who bought at that old support level is now losing money. If the price gets back up to that level, they're just dying to sell and get their money back. So a former floor of buyers becomes a new ceiling of sellers. The map literally redraws itself. And this all leads to the big question, right? You see the price coming up to a key level. It's decision time. Is it going to bounce off or is it going to smash right through? How can you get a better read on what's about to happen? Well, this is where we bring in the advanced tools. Think of these as the extra clues that pro traders look for to confirm what the map is suggesting and to give them more conviction in their trades. And one of the most powerful confirmation signals is one that's often completely ignored: trading volume. Volume tells you the story behind the price move. It shows you how much conviction there is behind the buying and the selling. So here's how you use it. If the price comes down to support and you see a big spike in volume, that's a strength test. It shows a huge wave of buyers stepped in. On the other hand, if a price breaks through a ceiling on a massive surge of volume, that breakout is way more likely to be the real deal. And sometimes you'll see a gigantic climactic volume spike after a long trend. That can actually be a sign of exhaustion, signalling the trend might be over. Volume gives you the context, And finally, we have what might be the holy grail of confirmation signals, confluence. This is simply when multiple different reasons all point to the very same price level. So, for example, imagine a stock pulls back to $100. That $100 mark also happens to be a major peak from a year ago. That's your static support. And a key moving average is also sitting right at $100. When you get that kind of intersection, that's confluence. It's a high probability zone that traders watch like a hawk. So, at the end of the day, support and resistance levels are so much more than just lines on a chart. They're the visible footprints of the constant battle between buyers and sellers, between supply and demand, between fear and greed. And it leaves us with one final question to think about. Are you just drawing lines, or are you learning to read the market story?